Before this video starts, guys, I would appreciate it if you guys liked and subscribed to my YouTube channel because you guys are able to witness such an epic moment in history for free, like front row seats and everything. So I appreciate for the free likes. Hello there, nerds. Today, Manuel and I will be teaching you guys all about loans. Just joking, guys. That's not my voice. Now you're all perhaps wondering why this is a video instead of a PowerPoint or speech. Well, it's pretty simple. Number one, we won't have to present in front of the class, and number two, videos are more epic by 300%. Let's go! Now there's lots of loans for different uses in the world. There's a student loan, mortgages, or whatever you say, vehicle loan, and line of credit. Later on in the video, I'm gonna mention collateral a lot, so if you don't know what that means, then I'll explain it right now. So if the loaner doesn't trust you that much, they can ask for a collateral, and it can be anything that's worth money, so like a house, car, baby, etc. If you don't pay back the loan in time, then they will probably take your collateral and sell it. We will be starting on consumer loans for our first loan. A consumer loan is just any type of loan that involves borrowing money or anything from someone or company. There are also two methods they can pay the loan back, unsecured and secured. Unsecured loans are a type of loans that are less riskier to the lender because you don't have any collateral. Your loan limit will be lower and you will need to pay more interest. Secure loans are less riskier to the lender because they'll have collateral backing you up, and because of this, it will come with many benefits like lower interest rates, higher borrowing limit, and your loan will get approved faster. To get a loan, you will have to go to the bank or credit union and ask for one. The goal for the bank is if you can pay them back the money plus interest. So if you can do that, they will profit and you will get a loan, so it's a win for every side. The bank will have to investigate lots of aspects like when you need the money, proof of income, personal identification, proof of residence, and more. Starting off with student loan, which is used commonly by students that are going to post-secondary education. It can pay for the tuition, food, supplies. There is a 6-month grace period after you finish your education where you must pay back the money, and if you do pay it back before a 6-month period ends, you don't have to pay that much interest. There's two types of student loans, subsidized and unsubsidized loans. The main difference between these two are that subsidized loans are for people who are lacking in the financial department and the government will pay for some of its interest, and unsubsidized are for the non-lacking financial department people and the government won't pay for their interest. By the way, your school determines if you're in need or not. Not you, the school does. Mortgage loans are long-term loans for buying a new house where you must pay money back for a long time to the loaner because people just don't have enough money at that time. If you fail to pay back, the lender will probably take your home because your house is always collateral and sell it to regain their loss. Fixed rate loans keep the same interest rates until the loan ends, which means your monthly mortgage payment always stays the same. Fixed loans can last from 10 to 30 years. Adjustable rate loans do the opposite of fixed rate loans. It can go from very low to hella high interest rates depending on the economy, which can make or break your mortgage payment. Vehicle loans are self-explanatory and is used to buy vehicles that you will drive daily. It's the same as mortgage loans in the fact that they will take your vehicle if you don't pay it back in a certain amount of time. Last but not least, there's line of credit, which can be used for anything instead of the puny, inferior regular loan, which is limited to only one thing. The main difference from a regular loan is the fact that it's a revolving credit, which means you can get money as many times as you want until it reaches a set limit, but of course, you have to pay it back the limit if you want to use it again. Okay guys, I did everything that I was supposed to do, so now I'm just gonna hand over the mic to Emmanuel so I don't have to do that much more work. So yeah, bye, peace.
What you need to qualify for a loan. To get the bank's approval for a loan is based on three main factors: your gross annual income, how much money you make every year, how much you're willing to spend on the down payment, The down payment is a portion of the total purchase price you pay upfront before starting to loan. And your credit history. A credit history is a record of your ability to pay debts and demonstrate responsibility in repaying them. Lenders would typically want to see steady income for at least 2 straight years and a clean credit history. How to apply for a loan. Decide how much you can borrow. Find the right type of loan. Check your credit score. See what lenders are offering. Find out about eligibility requirements and annual percentage rate. Compare your options. Gather what you need to apply and fill out the application. Ways to repay your loan. Make a bi-weekly payment. Instead of paying monthly, you can repay your loan every 2 weeks. This will help you pay your loan faster. Round up your loan repayment. Example, you owe someone $100 and suppose you pay them $10 every month. So to repay your debt faster, you can pay them extra money like $12 instead of $10 every month to help you pay your loan faster. Consequences of defaulting. Defaulting on a loan happens when repayments aren't made for a certain time. Defaulting loans will drastically reduce your credit score, impact your ability to receive future credit, and can lead to seizure of personal properties. If you can't make payment, it's important to contact your loan lender or loan service to discuss restructuring your loan terms. When a loan defaults, a debt collector is sent to contact the borrower and receive the unpaid fund. Reasons to consider before co-signing a loan. You're responsible for the person you're co-signing because they have to put their trust into you. It means that you're going to support them financially if they don't pay the loan back. Here are a list of scenarios that can happen when co-signing a loan. Your credit score could get impacted. For example, you need a loan for yourself and you find out that your application got denied because your credit score is too low. That happened because you co-signed to someone and it lowered your credit score. Another scenario could be that the person you're co-signing for is not paying the loan payment on time. So, since you co-signed the loan, this late payment will be reported to the credit bureau and will negatively affect your credit score. Your savings might suffer. Say you worked hard to save for things you need in the present and your future retirement. If the person you co-signed with loses his job or something happens in an emergency that they can't pay the loan, you're going to spend your savings to make up for the payment, and this will impact your financial future. Could impact a relationship. When you first co-sign a loan, that person is getting the loan they need, and you're helping them out with whatever they need, so everyone's happy. That phase is called the honeymoon period. But just like many relationships, this phase doesn't last very long. If the person you co-signed a loan with pays on time every month for the duration of the loan, everything is pretty good. However, if one or more payments are missed or late, the co-signer will have to pay the loan back, which will probably make you angry because you were saving up for a PS5. When things go bad, the lenders will come after you first. For example, you co-signed to help someone to buy a house, but they didn't pay the money on the second payments, on 2 payments. The first person the lender will come to is you. Wonder why? Well, by co-signing a loan, you are the person supporting the borrower to get the loan. In this case, the lender is more confident to give the borrower a loan because you agreed to back up the borrower if they can't make the payments. The lenders then will assume that if the borrower doesn't have enough funds, to make the payments, you are the first person contacted and potentially sued. Be sure, be sure to get copies of all important documents just in case something happens. You should always have access to important documents. You might need it in case there's a dispute between your consignor and the creditor, so that you can cancel it.